Good afternoon. So wonderful to see so many of you here. And thank you for coming to our analytical corner on diagnosing the slowdown in global growth. My name is John Bishop. I work in the Secretary's Department of the IMF. I'm going to be the moderator for this session. So before we begin, may I ask you to please silence your cell phones. I'm going to invite my colleagues Cedric Oku and Robert Zymek onto the stage. They're going to present for about 10 minutes, and then we'll open up the floor for questions. So let's just get right to the main event. Cedric, Robert, please. Round of applause, everybody.
Imagine you are working for an employer that raises your pay by 3.8% above inflation every year. If you stick with her for 18 years, your real income will double. That means you can afford meals for your family that are twice as good, a healthcare plan that is twice as generous, a home that is twice as large. To most of us, income growth of 3.8% per year will sound like a great deal. And it happens to be the path that the world economy was on before the pandemic.
Now imagine that your pay growth was only 2.8%. It doesn't seem like a big difference, but at this lower rate, it would take an additional 7 years to double your household's standard of living. If nothing else changes, this is the path we project for the global economy by the year 2030. This decline makes for a sobering outlook. Our global household still contains many poor members who cannot afford to wait for a brighter future. The global household also faces many challenges, including high debts and the green transition, for which it would be handy to have some petty cash in the coming years. My name is Robert Zymek, and I'm an economist in the IMF Research Department.
And my name is Cedric Oku, also an economist in the IMF Research Department. In this presentation, we will unpack the drivers behind the recent decline in global growth prospects. We will explain why, on current trajectory, global growth is set to decline to its pre-pandemic average of 3.8% to 2.8% by the end of the decade. And we will ask the question, what will it take to turn the tide of slowing economic growth? The bars behind me show annual average global growth for different periods since 1995. The line shows growth per person. Both peaked during the first decade of the millennium, and both have been declining since. As we will explain, several structural factors have been behind this decline, and they are set to continue affecting growth in the medium term.
Breaking things down some more, there are three main drivers of economies' capacity to generate income. The chart shows the contribution of each to recent global growth. The first is total machinery and equipment available, capital for short, shown in blue. The second is the available labor force, shown in yellow. The third is the effectiveness with which capital and labor are combined, known as total factor productivity, or TFP for short. As you can see, the growth rates of labor, capital, and TFP have all declined. However, the decline in TFP growth is most pronounced and has made the single biggest contribution to slowing global growth. For this reason, we will start by unpacking the decline in TFP growth before turning to labor and capital. Now, TFP growth represents advances in an economy's total productivity. Higher productivity means goods and services can be produced with more goods and services can be produced with the same resources. One contribution to TFP growth is innovation by firms in production technologies and production processes. We already know that such innovation has slowed in recent decades. However, our work identifies another important source of the recent slowdown in TFP growth, and that is known as allocative efficiency.
So-called allocative efficiency measures how well firms' access to capital and labor reflects their productivity. Consider an example of two firms, one with high productivity, one with low productivity. If a lot of capital and labor is stuck in the unproductive firm, this drags down the overall productivity of the economy. And we say that allocative efficiency is low. If, on the other hand, capital and labor is in the hand of the most productive firm, allocative efficiency is high. If it is getting harder over time for the most productive firm to attract capital and labor, we will say that allocative efficiency is worsening. This is exactly what appears to have happened between 2000 and 2019 for advanced economies and emerging market economies. By one measure, declining allocative efficiency on average knocked half percentage points off TFP growth during this period for advanced economies. In a more selected sample of emerging markets, TFP growth was reduced by 2.5 percentage points on average. As the chart shows, most of the decline in allocative efficiency occurred in the decade prior to the global financial crisis.
Now, what explains this loss of allocative efficiency? There are two main explanations. First, services sectors tend to have lower allocative efficiency than goods-producing sectors. This can be seen in the box plot, which shows that across countries, the productivity loss from poor allocative efficiency is larger in services than in goods. Therefore, as economies become more service-oriented, their allocative efficiency declines. This has been an important trend for some economies, most notably for China. The second explanation is that firm growth was highly uneven across many economies during the period leading up to the global financial crisis. And what the data suggests is that the allocation of capital and labor has not yet fully caught up with the firms that most successfully innovated during this time. Fortunately, there are measures that can help improve allocative efficiency. As can be seen in the chart, over the long run, allocative efficiency is higher in economies with lower barriers to market entry and competition. It's also higher in economies with more flexible labor markets. What this tells us is that much allocative efficiency springs from frictions that prevent markets from moving capital and labor quickly to their most productive uses. Removing frictions such as anti-competitive practices, corruption, or state intervention championing selected firms can raise allocative efficiency. In turn, this will support TFP growth and may help economies adjust faster to possible future shocks. So, a deterioration of allocative efficiency has contributed to a major slowdown in TFP growth. What about the growth of capital and labor?
On labor, most of the decline is due to demographic factors such as lower fertility and aging population. The growth in working age population, those aged 15 to 64, has declined in every economy below the 45-degree line in the chart. Clearly, this encompasses most countries in the world and almost all major economies. Only a number of low-income countries, predominantly in the Middle East and North Africa, and Sub-Saharan Africa region have experienced a rise in labor force growth. The share of working age population who are employed or actively looking for a job has also fallen in most world regions. However, here, the experience of advanced economies hold an important lesson. Advanced economies have managed to counter this aging population effect by significantly increasing labor force participation rates of women. Robert, what about investment?
Aggregate business investment in OECD countries fell sharply after the global financial crisis. It was 40% below trend in 2021, as shown by the gap between the solid and the dotted lines in the left-hand side chart. We estimate that about half of the shortfall in investment can be attributed to the weakness in economic growth, as seen in the yellow line. The right-hand side chart decomposes the decline in business investment rates of listed firms in advanced economies. And out of the portion of the decline that can be explained by a statistical model, roughly 1/3 is due to macroeconomic factors and 2/3 due to firm attributes some of which also respond to macroeconomic developments. So the bottom line here is that capital formation appears to be very responsive to macroeconomic conditions. Part of the slowdown in capital growth thus seems to reflect the decline in TFP growth and labor force growth described earlier.
Now, what does all this imply for global economic growth in the medium term? Extrapolating from recent macroeconomic trends we have described, assuming given policy and no major shocks, global growth looks set to decline to 2.8% by 2030. This is because recent trends point toward a further decline in TFP growth. Meanwhile, population dynamics will slow the expansion of labor force to a virtual standstill. Both forces together are likely to put the brakes on capital investment. As the figure shows, our projection implies that medium-term growth could fall 1 percentage point below the growth rate that prevailed during the first 2 decades of the millennium. This could create a tougher economic environment for poor countries looking to close the income gap with richer economies. It could threaten debt sustainability. It may hinder the much-needed green transition. But we shouldn't take this gloomy outlook as written in stone. Robert, can policy actions help?
Policymakers can indeed take steps to address this growth gap. These include structural reforms that improve allocative efficiency, such as removing barriers to competition, facilitating job transitions, and addressing distortions in credit markets. They also include labor market reforms, such as incentivizing participation and removing discriminatory barriers, especially for women and minorities. Our analysis suggests that an ambitious but realistic reform agenda could close much of the growth gap. If, in addition, we avoid possible headwinds, such as geo-economic fragmentation, and with a little boost from new technologies, we may yet be able to return to the economic dynamism of the first decades of the millennium. So put simply, with determined policy action and a little bit of luck, we may yet be able to turn the tide on slowing economic growth. And that would give our global household the raise we would all like to see.
Cedric and Robert, thank you so much. Please take a moment to scan the QR code here if you'd like to get a little deeper into the research. All right, now it's time to hear from you, hear from your questions. I'm going to open up the floor. We have a colleague with a mic who can bring the mic to you. When you ask your question, if you could give us your name, your affiliation, and a short question. We want to get as many voices in as possible. That gentleman right there was first off the marks.
Hi, my name is Eduardo Andrade from Ares Global Fund. My question is, which are the policies that you think are the most successful in terms of increasing the women's labor force participation?
So our analysis shows that in many advanced economies, policies that increase labor force participation for women were able to counter the effect of aging population. These policies include support for childcare, support for maternal leave, and other policies that allow women to have enough flexibility to work, to join the labor force in advanced economies. Now, these policies can also be used in some of the emerging markets who, as our analysis has shown, are also facing the demographic drag that comes from aging population. That said, we see that for low-income countries, we see that labor force participation, the working age population is been growing, and that low-income countries, in particular those located in North Africa in the Middle East as well as Sub-Saharan Africa are able to still leverage the demographic dividends and benefit from the growing labor force. Thank you.
Robert, anything to add? Or all right, wonderful. Next question. Could we have the gentleman there in the purple tie?
Hi, John Rodone, United States Department of the Treasury. In your research, did you find any effect of changes in cross-border investment on total factor productivity growth or declines? Thank you.
So the sort of key elements of the research is we're looking at some basically big macro trends that have affected the sort of broad membership of the IMF over the last few decades, and we use these to extrapolate out for thinking about the growth of capital, labor, and TFP in the future. And that's sort of what gives rise to the picture that you saw earlier. Now, in terms of thinking about cross-border investment flows, some of our analysis on what's been behind the drivers of capital flows speaks to that. We didn't show these results explicitly, but specifically for like emerging market countries, we saw that investment rates were supported during the period of the first 2 decades of the millennium by flows of capital into these countries. And that was an important part of the macroeconomic environment that these countries face that helped facilitate investment and growth.
Okay. Other questions? So this gentleman in the front, bring you a mic, sir. If you give us your name and your affiliation.
Hey, how's it going? This is Pedro. I am originally from Mexico, and my question would be if we are considering, I guess, or looking at the global growth by regions. And I'm saying this because Mexico, after the North American trade agreement, we went from the 16th to the 12th economy. So we ended up going up in places. So I'm thinking, I haven't seen Canada's number, but the US have also grown as well. I'm thinking that maybe we should also look at regional growth rather than by country.
So our analysis looks at global growth. We didn't focus on specific regions, even though like our analysis has the granularity because it's a bottom-up approach. So we start from growth and the drivers of growth at the country level, and we aggregate them up. So we do have that regional perspective. But our key message is to understand what are the drivers behind the recent decline in global growth, and we identify that we have the biggest contributor is a slowdown in global productivity, which partly reflects an increase in the misallocation of capital and labor between firms. So we are taking a global approach, but we do have the granularity because we are aggregating country level growth to the regional level and then at the global level.
And I would add maybe one thing, which is that if you take a look at the chapter, we have a little bit of decomposition of the global growth picture into some regional breakdowns as well. And perhaps one of the elements of heterogeneity to point out is that the chart that you saw that showed the changes in growth rates across recent periods, the sort of hump-shaped nature of this chart where there was a rise in growth just before the global financial crisis, that is primarily driven by emerging market economies, actually. Advanced economies have had a more steady decline in growth, whereas for emerging market economies, there was a period of higher growth up just before the global financial crisis that has also since turned into a period of declining growth, sort of tracking the ebb and flow of globalization trends as well during this period.
Wonderful. Some other questions. We have a gentleman in the back. Yes, with the.
Thank you. Fascinating piece. Kelly Hempel, I'm an investor. And when you talk about allocation efficiency, it sort of runs in the face of a lot of the political dynamics currently. I was curious to see how you felt tariffs have an impact on this, and as we see more and more trade barriers be put up, if you have some rough rule of thumb in terms of what you expect the impact on growth to be, that'd be great. Thank you.
So our analysis looks at potential frictions, right, that can impede the flow of capital and the flow of technology. We did look into the impact, the potential impact of geoeconomic fragmentation, and our estimates suggest that if geoeconomic fragmentation intensifies, it can put a drag on medium-term growth and lower medium-term growth by about 0.8%. So, of course, we want to acknowledge that there is also uncertainty about how geoeconomic fragmentation will unfold. So these forecasts are also based on the assumption that we have different blocks that start trading more intensely within each other rather than collaborating across different blocks. So, yeah.
Great. Let's see. Another question from the audience. The gentleman here in the second row.
Sorry.
Yes, there you go.
Mansour Mian, Saudi Arabia, Ministry of Economy and Planning. So on population dynamics and human capital growth, we're seeing a lot of human capital outcomes that are not up to par, specifically when you look at the working age population. But when it's talking about early childhood development or inclusive aging, pre-primary enrollment rates, health, non-communicable diseases, do you look into that as a barrier for growth in the global picture, and how does that affect the work that you looked at?
Yeah, so as I mentioned before, a lot of the work we do kind of extracts from some big macro global trends from the last couple of decades to the medium term, which basically means to the end of this decade. And so as such, a lot of the projection related to human capital growth is related to demographic factors that are already pretty much baked in towards the end of the decade. And so you're raising an important point that, for example, so we don't specifically look at investments in human capital simply because the time horizons here go much beyond the medium term. And these kind of investments are clearly very important for long-term growth, especially in many of the countries that, as Cedric said, reap the demographic dividend by having high population and labor force growth. But it's not something that's directly affecting our medium-term forecast because the return on these investments takes much longer than towards the end of the decade to materialize.
I think we have time for one or two more questions, if there are any more from the audience. Let's see, yes, right there.
Thank you. One often mentioned remedy for misallocation is homogeneous tax codes. I don't think you mentioned it. Do you find it's not that important? Thank you.
So we do look into misallocation and how it affects productivity. We also identify a range of policies to kind of reduce the negative impact of misallocation on TFP growth. We did not specifically look into, like the taxation, but that is definitely, like part of the policy tools that policymakers can use to kind of reduce misallocation and boost productivity and make sure that the most productive firms are able to attract capital and labor so that the overall productivity of the economy actually increases.
Maybe one thing to add is that there's some excellent work by colleagues of ours from the April 2017 Fiscal Monitor, which actually looks at the question of tax policy and how it might affect allocative efficiency in economies, which might be worth taking a look at.
So our time together is drawing to a close, but before we wrap up, it's big picture time. What's the one thought you want to leave our audience with?
So our main takeaways are threefold. First, we document that global growth is projected to slow down by the end of the decade and reach 2.8%, and that is a full percentage point below the pre-pandemic average. The second point is that this slowdown is mainly driven by a slowdown in global productivity, which reflects an increase in misallocation of capital and labor between firms. And the third point is that policymakers can take decisive steps to boost medium-term growth, and that includes implementing structural policies to improve the competition, to also increase the flexibility of the labor market, and also policies to ease access to finance. Those are the key messages.
Wonderful. Thank you so much, everyone. Please, a round of applause for Robert and Cedric.